Right, let's shift our conversation now to a little more fundamental story of the day. And with that, we're being joined by Mayuresh Joshi, who's the head of Equity Research India, William O'Neill and Company. Good morning out there.
Morning, Nikki. Pleasure to be on your show.
All right, Mayuresh, I'm going to quickly chat about hotel stocks with you because in the last 15 days or so, the momentum and the commentaries coming out from the management have been clearly building in, right? We're seeing Indian hotels talking about the business being at the pre-COVID levels. We're talking about Lemon Tree and management coming out and saying that the outlook looks more upbeat. What do you make out overall out of this space? And how much do you think this momentum is pretty much temporary, or do you think actually the fundamentals are kind of aligning with the way the outlook is stacking up for all these companies?
So for the sector as a whole, I think two things which moved in their favor, specifically in the last 4 quarters since the unlock trade began. A lot of domestic travel started happening on a robust scale. You call that revenge travel or revenge spending. But I think the kind of traction that came through, specifically in the last 3 to 4 quarters, and that is still continuing. This quarter and the next quarter is expected to be the best, being the holiday season around, and a lot of inbound foreign travelers as well. So to that aspect, I think the last financial year was fabulous for the sector as a whole. Coming out of the COVID period itself, occupancy levels had gone significantly higher. The average room rentals had gone significantly higher as well. And therefore, I think kind of numbers that the stocks have posted, even in the quarter gone by, Nikki, I think numbers have been fabulous. Expecting the numbers to be very, very good even for the quarter to come. And obviously quarter one, which is the best quarter for the sector as a whole. But again, I think if you probably stack up numbers, if you look at how the numbers have stacked up for the last financial year, can the hotel stocks outbeat their own earnings in the next financial year to the extent of 20-25%, and therefore justify the premium valuations that these stocks are trading at? The second element in terms of their strategy itself, a lot of these hotel stocks or hotel companies are pouring into tier 2, tier 3 cities, asset-light model, managing hotels, using their brand names as well for management, and therefore I think alleviating their capex plans will probably ensure that the earnings growth remains stable. So to that extent, I think the companies which are probably lesser leveraged at this point of time can still have their momentum on. But to a large extent, I think the valuation catch up in terms of whether they can outbeat their earnings in this coming financial year compared to the last will be difficult to do in that extent of 2025, and therefore having a premium multiple as well. So I think a few of these mid-cap hotel stocks can do well in terms of momentum. Stocks like a Chalet, where I think EBITDA margins are relatively high, or even Lemon Tree, their margins are way higher than 45-50% asset-light model being followed, and the management expects debt or leverage to come off. So I think a few of these mid-cap hotel stocks can have some momentum, assuming this quarter, the next quarter is still expected to be the best for the travel or the tourism industry.
All right, Mayuresh, we were, just before you joined in, we were just talking about the commodity stocks and overall how volatile they've been playing out, right? We saw first there were this resurgent hopes that now that China is reopened, we'll probably see same amount of traction building in for these counters, and probably the spreads would go back to the levels that were seen in 2021. But clearly the volatility, the picture isn't as rosy as most of the analysts around or some of the brokerages painted. What do you make out of it? And of course, between the ferrous and the non-ferrous space, I'm sure your preference is more towards the non-ferrous space. But within ferrous space, which are the names you like, and how do you expect the sector to play out?
So for the ferrous space as a whole, Nikki, you're absolutely right. What happens with China becomes a key pivotal point. Yes, we are expecting a huge amount of package to come through, a lot of support to come through for the Chinese real estate, which has really been battered in the COVID wave that they had in the last couple of quarters, and the kind of defaults and run to the bank that we have seen. But no significant announcements, and kind of disappointment that you've probably seen in the index is very, very apparent. The second aspect, obviously, is that China is a huge reprocessing economy, but to a large extent, the global demand itself is expected to be extremely subdued for the better part of this financial year as well. If you hear what Lagarde had to say, the ECB chairperson, inflation is a monster. I think that was a statement that she had put out. And therefore, we need to control or tame that to whatever extent it probably takes. yesterday Fed Chairman Powell's statements in terms of how data points are stacking up. And therefore, I think with an interest rate trajectory which is expected to go higher and faster for the developed world, demand obviously is expected to come off quite significantly. With subdued demand, the LME prices itself are expected to remain extremely soft. And to that extent, I think the realization growth that one really expects from metal companies, because of the natural economic factors, demand remaining soft and prices coming off, but the operating leverage does not come onto their balance sheets at all. Yes, I think deleveraging has happened for most of these companies during the COVID period. But I think with these two factors playing out, I think a significant amount of leverage is not expected to get played out in terms of balance sheets. Input costs a little bit higher, inching higher because of the China factor, whether it's iron ore, coking coal. So to that extent, I think how much of price pass-throughs is possible in a soft demand environment also will weigh in terms of the EBITDA and the absolute reported EBITDA per ton as well. So expecting, I think, a couple of subdued quarters for ferrous as well as non-ferrous players, and that is expected to play out on the prices. So I think expecting softness to continue or an underperformance for the metal indexes.
All right, Mayuresh, one last question that I will squeeze in for you at this point of time. Let's talk about the cement pack overall. What do you make out of it? Because we've seen probably there's this underlying momentum building in, or the speculation that Adani's might just go slow on their expansion and price hikes might just come through. And of course, Q4 is relatively a seasonally strong period for cement companies. But from a valuation perspective, which companies look attractive, and where do you see a pocket of strength coming in for this sector overall?
So absolutely agreed. I think Q4 is expected to be extremely strong. You're coming out of the monsoon season, the kind of budgetary spends that have been put through, specifically in terms of infrastructure, road, port, highway development, rural affordable housing as well. Cement companies do remain in focus. The second element in terms of the overall capacity, Nikki, 750 million odd tons for the sector as a whole, 550 million tons in terms of utilization levels, close to around 72 odd percent. With the kind of developments that have happened, the expectation largely was that the Adanis will spend significantly in terms of capacity expansion for both Ambuja ACC combined together. They might go a little bit slow on that one. And because of that, I think the overall dynamics of the sector as a whole should improve because of lesser capacities coming through and more utilization as demand kicks in for all government stroke private-led projects as well. So that should exceed 75, 76 odd percent, triggering in the operating leverage benefits that these companies will take. Now, even on a quarter-on-quarter basis, my own take is that what you've probably seen in terms of softening of prices and the pass-through that we've probably seen in the previous few quarters, an absolute EBITDA per ton rise should be seen specifically with input cost softening as well. With crude and crude prices coming off, freight and logistic costs should also work in favor of these companies as well. And with domestic demand and offtake expected to remain robust at this juncture, the expectations of stronger volumes playing out should reflect positively in terms of both the EBITDA per ton at this point of time. From a stack-up perspective, I think the leadership stocks is something that we always believe at in O'Neill. UltraTech probably looks very, very close to its pivot at this point of time. Capacity additions in full swing, expectations of EBITDA per ton improving quarter on quarter. And though valuation-wise, the stack-up might be a little bit heavier in terms of price when it comes to the standard deviation and compared to the other companies as well. I think it's well positioned in terms of both the geographical mix and the expectations of granular earnings growth playing out on its balance sheet. So we stick with leaders. UltraTech probably remains on the balance sheet.
All right, Mayuresh, that's a fair call coming in on that one. Well, lower freight costs anticipated along with the strong volume uptick coming in, overall positive for cement companies, overall EBITDA per ton. But Mayuresh, we'll just leave it at that. Thank you so much for taking out the time and speaking to us.
Thank you so much. Always a pleasure.